I'm Caroline Hyde. This is Bloomberg Technology. Coming up, Google's advertising crisis goes global. Big brands in the US join the UK in the backlash over terrorist videos. Plus, Fitbit turns 10. CEO James Park reflects on the early hypergrowth and the recent troubles facing the company in its turnaround efforts. And the Senate votes to nullify FCC broadband privacy rules. What that means for internet giants and your data. But first, to our lead, Google's advertising crisis goes global. It began with an investigation by the London Times newspaper, which found that some ads ran with YouTube videos promoting terrorism and anti-Semitism. The Guardian newspaper, advertising giant Havas, and even the UK government pulled UK ads from Google's display network and YouTube. Then, Wednesday, the boycott spread across the Atlantic, with AT&T, Verizon, Johnson & Johnson halting spending on display ads and YouTube as well. Google tried to head off the backlash this week with updated policies, but Alphabet chairman Erik told Fox Business earlier that Google can't guarantee ads will not appear against content advertisers find inappropriate. So how big of a problem is this for Google? Wieser, senior research analyst at Pivotal Research, downgraded Alphabet to hold on Monday because of this story. He joins us by phone. For industry perspective on digital ad spending as a whole, Emarketer senior analyst Verna joins us via Skype. And also with us, Bloomberg technology reporter Mark Bergen, who covers Alphabet for us. And Mark, I do want to kick things off with you, because how indeed has it started to gather strength this side of the Atlantic?
Right. I mean, there's a particular question I've been asking everyone is why now? Because this is not a new problem. YouTube has had this for years, and ever since the onset of ads. Now, there's a couple things. I think one is the political climate that we're in. There's a lot of sensitivity around fake news, around hate speech, around terrorism. The second is there's been this kind of a growing noise in the advertising industry about Google and Facebook and the control they have. And there's marketers been pushing for more uniform measurement standards and third-party audits. Now they're kind of seeing an opening, and they're really seizing it. I mean, breaking news at JP Morgan also following on, and they're taking ads off YouTube. Correct. That was announced today, yeah. So it continues to spread. Brian, first to you. Of course, you downgraded Alphabet, the parent company of Google, to hold on the news that it had affected the UK, but your worry was that this could have global repercussions. It clearly does. How much do you worry about the stock's performance going forward?
Well, I think it's subject in small part, if not major part, to headline risk from here. Namely, you'll see more brands demonstrating their concern and announcing that they'll also be pulling their ads from YouTube. And, unfortunately, so far, Google does not appear to understand the gravity of the situation. It's really, in some levels, mind-boggling. On the other hand, it's not surprising because this is very googly, I guess. So, this will continue for a little while. They'll solve it eventually. But when I meant that the repercussions would be global and would have an impact on their business, it's not about the boycott per se. We'll never notice that. We'll never see it in the numbers. Unless this actually did persist for weeks on end. What is going to happen is that every advertiser is now going to have a conversation with Google that is not focused on what the strategy should be in using search to enhance brand building, not what the strategy is on how to think about moving money from TV into digital and into YouTube, not on how to shift spending into Google from Facebook or one way or the other. The conversation is all about brand safety. Google is completely on the defensive for the next 3 to 6 months in any conversation they have. That will have a meaningful impact in terms of their ability to expand the business at the pace that they would have with the large brands that are serviced by agencies.
Paul, let's take it out a step and let's look a little bit at, if you will, the display ad business and YouTube that it is affecting. This isn't the search business of Google. This isn't the major cash cow. How does this affect in advertising spend generally?
Right. Well, yeah, just for a little perspective, search, as you said, is Google's bread and butter. It represents about 3 times what is spent on video on YouTube. So search in the US is about $37 billion this year, and about 78% of that is on Google, so they're by far the dominant player. If you look at video advertising, that's about $12.5 billion. So again, it's about a third of what search represents overall, and Google has about 20% of the US digital video advertising business. So we are talking about big dollars. This does come at a critical time for Google because, as Brian was saying, you know, they're trying to expand the conversation. They're trying to draw those TV advertising dollars. They're trying to present themselves as more of a haven for TV-style advertising. You know, the search business is something that they've been doing. They know how to do. It will continue. They know it better than anybody else. But video is something that, you know, certainly Google and YouTube have a major presence, but there are a lot of other players who are vying for those same TV advertising dollars. So the stakes are very high.
I mean, Mark, you've been nodding your head throughout, and Brian called this rather googly in perhaps their lack of reaction. We've heard from Erik Schmidt, we've heard from the Chief Business Officer, but why are they not reacting faster, or are they indeed not taking it seriously enough?
Well, I think, and just to be fair, Brian is probably the only analyst that's downgraded. I talked to other analysts that are sort of shrugging this off, like to his point that this is not going to be having a material impact on the revenue. And maybe there's not this expectations that this might change the caliber of the conversations. But, you know, Google's kind of weathered this before. The sense I get is that they're not really panicking, and maybe to Brian's point that they should be. I think that we have to think about the fact that a lot of advertisers don't have a lot of other options. I mean, as people have said, where else are they going to go? They might go to Facebook, they might go to Snap as a new emerging advertising channel, Verizon, AOL, but Google's really still like the best bang for their buck.
Paul, talk to us about the rivals, because I think that's interesting that we heard from Verizon, which now, of course, is in the steps of owning Yahoo and might well be rather dining out on this continued problem. Who might be the winners here?
Well, it's interesting that some of the companies that have pulled their advertising from YouTube, at least temporarily, are ones that do stand to benefit because they're in direct competition. I think, though, that when you look across the competitive landscape, what's interesting to me is that all of the potential players, and we've mentioned all of them, or many of the major ones, they really all have the same risk level as YouTube had. What just happened is not necessarily a YouTube problem. It's a programmatic advertising problem. It's a problem that happens when advertising is propagated through an automated system throughout a very, very broad network of websites and digital properties without necessarily being able to control and vet every single one. So Facebook has faced similar issues with its ad platform over the past year. Snapchat has had some problems and probably will continue to. And I think as long as advertising is bought and sold this way, it will remain a risk. You know, Google has said that they can't guarantee 100% brand safety. And maybe the issue here is, can they go from, say, 98% to 99%? They definitely need to do more, but I don't know how much more they can do. And I also think that other competitors are facing the same basic problem.
Brian, finish it off for us here, if you will, because you've downgraded it to a hold. What would take it from Alphabet? What moves would you like to see to move it back up to a buy and to continue to see the price target move higher? Or indeed, what would really worsen it if we do see you go even to a sell? What would have to be the key catalysts here?
Yeah, well, let's be clear. The downgrade was in part because the stock has risen since the last time I published a note on Google. So the stock up, the price target down just a little bit, and it's necessarily becomes a hold. If the price had been a lot lower already, then it would have stayed a buy. But no, I think that what happens next. I think it's going to be a little bit of time. The right answer is not, unfortunately, 98 to 99%. The right answer is 0. I think large brand advertiser expectations are that if Google is a company that can have a moonshot for self-driving cars, a moonshot for balloons over New Zealand to bring internet access to sheep, a company that can have robots running down the street, they can surely have a moonshot for a 100% brand-safe environment, even if they don't completely get there. And they have not articulated that goal because, unfortunately, one screenshot of a brand sponsoring a beheading is one too many.
So investment needed and a clear action plan. Brian Wieser, Senior Research Analyst at Pivotal Research. Been great to have your opinion, along with Paul Verna, Senior Analyst at Emarketer. Thank you for joining us on Skype. And Bloomberg Technology reporter as ever, Mark Bergen. Brilliant to have you with us. Now, a story we're watching. WikiLeaks has released new documents that reportedly contain techniques the CIA uses to infect Apple devices. According to the group, there were several CIA projects devoted to infecting Apple Mac computer firmware. Now, that means the infection remains even if the operating system is reinstalled. The documents also disclose tools to infect iPhones. Earlier this month, WikiLeaks founder Julian Assange said he's willing to work with tech companies to close the security gaps identified in these documents. The CIA has said it does not confirm the legitimacy of such leaks. In other Apple news, well, the iPhone company has finalized a deal to acquire the startup Workflow. It's an app that allows users to hook together apps and functions in a string of commands to automate tasks. Workflow's 3-person team is being hired by Apple, and they'll continue to develop the app. Details of the financials were not released. Coming up, Fitbit hits a major milestone. We'll hear from CEO James Park on the company's 10-year anniversary and what's next in Fitbit's turnaround strategy. And a reminder that all episodes of Bloomberg Technology are now live streaming on Twitter. Check us out. It's at Bloomberg Tech TV, weekdays at 5 p.m. in New York, 2 p.m. right here in San Francisco. This is Bloomberg. Fitbit is turning 10, and the last decade has been anything but a walk in the park. 5 years ago, Bloomberg's Corey Johnson took a walk with the then private startup CEO, James Park. Now, 5 years, one IPO, and over 60 million products sold later, the two took another walk on the streets of San Francisco.
When we talked 5 years ago, you said we're software guys making hardware.
When we started, I don't think we thought about the challenges that we would encounter. We just went ahead and did it. My co-founder Erik and I are really software guys. We had never done hardware.
Now, 5 years later, CEO James Park is sticking to that claim, even though it's the company's hardware that's made Fitbit a household name.
I mean, 2/3 are engineers, software engineers versus hardware engineers. But it's really about the combination of the two working well together that create the magic. So I don't know. I don't think we can classify ourselves as strictly a hardware company or a software company.
Hypergrowth might be a hard thing to manage, but growing sales more slowly can be just as difficult.
We had a rocket ship of a company for quite a long time. I mean, as you pointed out, we shipped our first product in 2009, shipped about 5,000 units, and then last year we shipped over 20 million. So it's been pretty stratospheric growth, and now the challenge is we're moving into a slightly different environment. So it's a new set of issues that myself and the company has to tackle.
Which are what?
Moving from an environment where it's hypergrowth to one where I think we have to be more efficient and focus on fixing a lot of the things that we had kind of ignored in the past just because of our growth profile. But I think that's a good thing for the company. It's time for us to kind of reflect, look at the things that are working, not working, make the right fixes, and then chart a path back to growth.
Fitbit's first ever contraction has been painful to employees and to Wall Street. Since the company's IPO back in 2015, Fit shares have plummeted over 71%.
Are you glad you did the offering? So many companies have stayed private for longer periods of time, and I wonder, in retrospect, if you look back to the IPO, of whether that was something that were the negatives outweigh the positives.
There's always positives and negatives to a lot of these decisions. The positives for us is that for the longest time, we weren't very well capitalized as a company. We had hyper growth, but our balance sheet was always pretty light. So we always viewed the IPO primarily as a financing event. And when we went public, we raised hundreds of millions of dollars, and it was the largest consumer electronics IPO in US history. So that was a huge event, put a lot of cash on our balance sheet. I think at the end of December, we had approximately $700 million in cash. And so that gives, I think, a lot of confidence for us to operate the business going forward.
Working capital and
working capital, sleep at night money, R&D, M&A, all those things. It gives a lot of flexibility and security to the business.
When you look at the stock price, and I'm not, stock price is stock price, right? But I wonder what that means for you in terms of sort of the business plan and keeping the high margins that you've kept and other decisions that you've made there. You could certainly goose earnings, or goose sales, I would think, if you lowered prices and cut margins, but you've chosen not to do that. Why is that?
Pricing is something that you can't, reverse from. So, we want to make sure that people really value our products. And I think maintaining pricing discipline is an important part of that. And we do invest a lot in pretty significant and innovative and original research and development, and that's something that we want to continue. The stock price and the public investors, that's all very important considerations into how we run the business, but it's also one input. I think what shareholders would like us to see is to properly manage some of the short-term interests, but also look at the long term. And I hope that we're able to do that as a business.
Fading customer demand caused Fitbit's fourth quarter revenue to fall by 19%. Fitbit announcing a restructuring plan, taking a $4 million charge and laying off 110 employees. So how does Fitbit plan to turn it around?
We're going to streamline our product portfolio. Right now we have just way too many trackers that are out there. And then more importantly, a real focus on software, coaching, guidance, personalization, because the later adopters in this category really want solutions rather than just data and tracking. And then, we want to move into adjacencies like smartwatches. The acquisitions of Pebble, Vector, and Coin all play into that strategy. We've already announced that we're entering that category, and it's a move that will immediately double our addressable market. So that's a huge area of growth. Not only that, I kind of hinted that there's form factors beyond the wrist that we're looking at as well. And then as part of our restructuring and a reorg, we're looking at the business in two perspectives. One, consumer, but more importantly, what we call enterprise health as well, where we want to target, we've already targeted employers, but starting to target in a more focused way insurers and other partners in the healthcare ecosystem.
And the opportunity for you to write move 100,000 units at a time.
There will be incredible opportunity for bulk recurring sales tied to health plans.
Ultimately, it comes down to inspiring sales and getting customers on their feet.
What do you wish someone could have told you 5-year younger or 5-year younger you?
There's a lot of challenges today that would have been a lot easier to manage as a private company. Just because you're less visible, you're not being judged on a day-to-day basis.
Right.
And so a lot of the things you have to do to chart a path back to growth and profitability are, definitely a lot harder in the public spotlight. And what I think about on a daily basis is how we transform Fitbit into a product that's kind of a nice to have into something that's a must have. And a lot of that is going to come into how we integrate more effectively into the healthcare ecosystem.
That, of course, was Fitbit CEO James Park and Bloomberg's Corey Johnson. Coming up, we'll hear from one of the biggest players in online lending, Lufax CEO Greg Gibb, on his outlook for China and the fintech industry. And a feature we'd like to bring to your attention is our interactive TV function. You can find it at TV Go on the Bloomberg. You'll not only be able to watch us live, but also see previous interviews and dive into any of the securities or Bloomberg functions we talk about. And you can become part of the conversation by sending us instant messages during our show. This is for Bloomberg subscribers only, though, I'm afraid. Check it out at TV Go. This is Bloomberg. Greg Gibb, CEO of Lufax, one of the largest players in the online lending industry, says the company has benefited from the decrease in peer-to-peer firms in China and says regulation has grown over the last year.
The number of players in the industry, we used to talk about 2,000 to 3,000.
Now about 2,300, I think.
Right, now we're kind of talking about 1,000. Okay. And out of that 1,000, probably the top 20 have got 50% of the market, and then the other 980 have got the other 50%. So we've seen, for example, in our case, our market share double roughly over the last year.
Lufax completed a round of fundraising in January, valuing it at $18.5 billion. And shares of cybersecurity firm FireEye jumped in the trading session today after Goldman Sachs upgraded the company to a buy from sell rating and increased its price target to $15. The Goldman note says the introduction of analytics platform Helix will address many of the firm's previous challenges. And to Medium now, the online publishing company started by Twitter co-founder Ev Williams, unveiled its new business model, a $5 per month subscription service. Earlier this year, Williams swore off advertising on the Medium platform and cut 1/3 of its staff. Few details about the membership benefits have been released, but it will include exclusive content and early access to new Medium experiences. The site will remain free to those who are not members. And it looks like Bob Iger is sticking around at Disney. The CEO of over a decade has agreed to a contract extension that will keep him atop the world's largest entertainment company until July 2019. Though the businessman said he would not extend his contract after that date. Iger's annual salary will remain unchanged, but he'll get $5 million for agreeing to the new pact. The agreement settles who will run the company for the immediate future as the board of directors continues to search for his replacement. The move also gives Iger time to address problems at Disney's most profitable business, the media networks led by ESPN. Now, coming up, as Google works to rectify its growing ad controversy, more analysts are weighing in. We'll break it down. That's next. And if you like Bloomberg News, check us out on the radio, why don't you? You can now listen on the Bloomberg Radio app, Bloomberg.com, and in the US on Sirius XM. This is Bloomberg.
I'm Elisa Parenti, and you're watching Bloomberg Technology. Let's start with a check of your first word news. The Congressional Budget Office says proposed changes to woo Republican votes to repeal and replace Obamacare will narrow the amount of deficit reduction by more than half. The CBO says the tweaks would increase federal spending to eventually raise the size of tax credits offered to older people to buy health care. That would reduce the deficit by $150 billion over a decade, down from $337 billion. Authorities in Belgium have tightened security in the port city of Antwerp after a Frenchman drove his car at high speeds through a busy shopping area. Authorities say they found knives, a shotgun, and a gas can with an unknown liquid in his car, and a bomb squad was called in. It comes one day after the Brussels attacks, which killed 32 people 1 year ago. France's defense minister is drawing criticism from his Socialist Party for throwing support behind independent presidential candidate and election frontrunner Emmanuel Macron. Socialist Party candidate Benoit Hamon won the primary in January, but he has slipped in the polls. A new poll has Macron tied with National Front leader Marine Le Pen for left-wing voters. The first round of the election is April 23rd. The Trump administration will reportedly approve the Keystone XL oil pipeline as early as tomorrow. That is according to multiple reports. If approved, the fight shifts to the courtrooms, where environmental activists are plotting ways to block construction. Global news 24 hours a day, powered by more than 2,600 journalists and analysts in more than 120 countries. I'm Elisa Parenti, and this is Bloomberg. It's just after 5:30 p.m. Thursday here in New York, already 8:30 Friday morning in Sydney. I'm joined by Bloomberg's Paul Allen with a look at the markets. Paul, good morning to you.
Good morning. Trading's been underway for a little over 30 minutes in New Zealand. The NZX looking kind of flat, though, up barely 2 points right now. And it's looking like a quiet finish to the week around the region. Nikkei futures are very slightly off. ASX futures pointing up by just 5 points. Still could be a few things to watch today. In about 10 minutes' time, New Zealand will release its trade balance for February. That's expected to come in at $126 million US, so the currency might move there. Locally, keep an eye on Evolution. It's being reported that Citi is seeking bids for a block trade in the gold miner, pricing it at a pretty reasonable discount to Thursday's close. Elsewhere, plenty of post-earnings press conferences to watch around the region from China Mobile and CNOOC, and Samsung is going to hold its first AGM since the arrest of J.Y. Lee, so that could be a lively one. I'm Paul Allen in Sydney. More from Bloomberg Technology next.
This is Bloomberg Technology. I'm Caroline Hyde. And as we mentioned at the top of the hour, shares of Alphabet have been under pressure. That's as the company's advertising crisis is picking up steam. Let's bring in Bloomberg News stocks reporter Abigail Doolittle to give more reaction, as well as the broader markets. Abigail, first, let's focus on the US stocks, because what's behind today's losses?
Well, we had a bit of a roller coaster for the day, Caroline. The major averages, the Dow, S&P 500, the Nasdaq, opened slightly lower, only to trade higher. In fact, the Dow and the S&P 500 at the highs were up nearly 0.5%, and then right around 3 o'clock, 3:30, started to turn lower. This came as the House did delay voting on that health care bill, really adding some uncertainty, not just around whether it gets passed and what it will mean for Obamacare, but what does it mean for the reflation trade? Investors are really banking on the possibility that President Trump's policies could reinflate the economy, but that's unlikely to happen if this bill does not pass. So that's really what was behind these losses, a small extension of that sell-off on Tuesday. To take a look at those dips and gains on the day, here's an intraday chart of the Nasdaq, and you can really see that it was a bit of a volatile session on an intraday basis. In fact, the Nasdaq lagged the other two averages, was down at 1.25%, up less at the highs, and the reason being what you were talking about with Google. Alphabet was one of the biggest drags on the tech sector, in fact, also on the Nasdaq and the S&P 500. Plus, we also had Apple, Microsoft, and Nvidia trading lower. So a bit of a reversal yesterday when tech was the top sector, Caroline. We just have these high beta stocks whipsawing up and down. So today was a bit of a down day for tech.
Yeah, and in fact, when you're looking at Alphabet, it's down 4 days in a row now. I think it's about $22 billion wiped off of its market cap. Some analysts aren't all going much lower or concerned, but investors seem to care. Why?
Well, you know, so this is a very interesting thing that's happening here with Alphabet. Earlier, J&J did pull its advertising for Google's YouTube based on objectionable content. Just recently, within the last hour and a half, JP Morgan followed suit. And what's behind this, these companies really don't want their ads next to, again, content that could be objectionable, whatever the nature of it is. However, James Chakmak of Monness Crespi, I reached out to him earlier. He said that he thinks this is a near-term blip, that these huge advertisers cannot ignore a 1 billion user platform. And in fact, Paul Sweeney agreed with this. When we hop into the Bloomberg to get a better scope for Google Alphabet's reach, this is #BTV 2366. It represents advertising revenue, and we see that's been in the high teens. That's huge growth on a $90 billion revenue company. In fact, Bloomberg intelligence analyst Paul Sweeney, he says you just don't see that anywhere else. Right now, Paul Sweeney says this is a reputational issue for Alphabet, but if they don't stomp it out quickly, really come up with a response to it, it could turn into a business issue, that they want to prevent that from happening. Relative to the stock in the near term, though, it does appear that there could be just a little more pain ahead. If we hop back into the Bloomberg and take a look at #BTV 7070, this is Alphabet over the last 6 months in relation to its 50-day moving average in blue, which has been support, and then its 200-day moving average in yellow, which was support on the election sell-off. We see that on today's move down, it's sliced through that 50-day moving average. The last time that happened, Alphabet moved right down to that 200-day moving average. So there could suggest that there could be some more shaky trading action ahead for Alphabet, that investors are really going to be taking a little bit of caution as these advertisers perhaps move away from that YouTube platform, at least for now.
As ever, shining light on the technical indicators for us, Bloomberg News stocks reporter, brilliant analysis, Abigail Doolittle in New York. Thank you. Now, let's continue our discussion of Google with Bloomberg editor-at-large Corey Johnson. And we're hearing there that, you know, the stock has sold off to a certain extent. I spoke to Brian Wieser of Pivotal. He downgraded the stock to a hold. But he is saying that this is reputational to a certain extent, and it's the new area of growth. It's video where they wanted to get into.
Right. And I think that's a crucial part about this. This is the place where most of the growth was supposed to happen. So while they have this fantastic and enormously profitable business that is most of their business, the places where growth was supposed to happen was in video. So that's why I think that's the reason it is an actual concern for investors.
I think what's fascinating is what we just heard before we came on air, that JP Morgan is pulling it. But Verizon is an interesting one to look out for because they could potentially win out a little bit.
Well, so to me, this is the most interesting part about this, is that Verizon isn't just an advertiser on there. And this is non-search advertising we're talking about. But Verizon isn't just an advertiser. Verizon is a direct competitor with their acquisition of Yahoo. And indeed, both in AOL and at Yahoo, there was a big focus on the technology around video ads. And when they were doing all these acquisitions and spending so much money on this and talking in every conference call, both AOL was a separate company and Yahoo, and Marissa Mayer was running that business as a separate company, were talking about spending a lot of money on video and technology around video and serving video ads. What kind of technologies? Exactly the kind of technologies to make sure that ads show up in the places they're meant to show up where they have the most impact. So I think that Verizon announcing that they are throwing gasoline on the fire of this story and wanting to really fuel this because they want advertisers to think about other places they can put video online. They know that advertisers are going to continue to go there. They want to suggest, hey, stay away from Google, look at Yahoo. Because they're already looking at Facebook and Google. Increasingly what's happening in online advertising, it's becoming a two-horse race here with Facebook and Google gobbling up so much of the real estate out there. And so the question is, are advertisers actually going to bother to go to Twitter? Are they going to look at Snapchat? And are they leaving Yahoo to go to those new formats? Yahoo wants to try to keep what they've got and add to that. And Verizon definitely has to mix my animal metaphors, a dog in that fight.
I love an analogy or two. But when we're looking at programmatic overall advertising, this might not just be only Google's problem, though. This is a company that potentially needs to be spending more to invest to ensure that the right adverts in the right place at the right time. But could this actually spread? Could people turn their attention away from this juggernaut onto other video providers?
I mean, that's the hope certainly Verizon is having, and increasingly that's going to have to be the argument that other providers are going to have to make here, because Google's a very effective place for advertising when it comes to search, right? If someone searches for boat engine propeller, there's a high likelihood they're trying to buy a boat engine propeller. But video is much more brand focused and is a different kind of advertising. The people at Yahoo and Verizon, Yahoo, AOL, Verizon, Tim Armstrong's crew, really think that they've got an advantage at brand and they are better at brand than Google, and they want to sort of emphasize that's a place where they can focus, that video is a place where they can lead, and that mobile video, in fact, is even more of a focus where the winners, ultimate winners, have yet to be chosen.
We'll see whether anyone else is tainted with this or indeed held up as where to be looking for a better programmatic advertising. Great to have you on, and your analysis as ever. Brynjolfsson, Bloomberg editor-at-large, with everything on Alphabet's Google. Now, on today's funding board, SoundCloud says it has received $70 million in debt to fund growth plans. Earlier this year, the Berlin-based music service warned it may run out of money if it didn't attract more paying customers, since SoundCloud had secured a credit line from Erez Capital, Kreos Capital and Davidson Technology. In a statement, the company said the credit would be used for developing technology and hiring. SoundCloud's decision to take on debt comes after the company pursued raising additional funds from investors and considered a potential sale. Coming up, would companies think twice about automation if it comes with a tax for robots? We'll pose the question to MIT professor Erik Brynjolfsson next. This is Bloomberg. Now, a story we're watching. German software maker SAP plans to capitalize on President Trump's efforts to encourage US companies to repatriate cash held overseas. SAP CEO Bill McDermott says that plan could boost business spending on large-scale software upgrades. McDermott's comments come as the company announced the launch of SAP IO. It's a fund that will allocate $35 million for early-stage investments in software companies. SAP also announced new incubator programs in San Francisco and in Berlin. Meanwhile, automation is displacing more and more American workers and freezing pay for others. Now, the main fear isn't that all human workers will become obsolete, but that automation will increase inequality among humans. One suggestion to avoid this development? Tax the robots, or the company the robots works for. Joining us now from Cambridge, Massachusetts is Erik Brynjolfsson, Professor of Information Technology at MIT Sloan School of Management and co-author of the NYT bestsellers Race Against the Machine and The Second Age of the Machine, of course, as well. Wonderful to have you here, Erik. And first of all, what do you think about this? It was discussed a little bit by the likes of tech giants out there. Of course, Microsoft's Bill Gates thought that maybe taxing robots would be the right thing to do.
Sure. You know, Bill is a very smart guy, and I appreciate him thinking about this issue. But I don't think taxing robots is really going at it the right way. Robots create a lot of value. It's also, as you point out in the lead, there's been stagnating of a lot of wages, and the middle-income jobs have disappeared. So there's a question about how we should best go at it. Taxing robots isn't going to be the best approach, though. I think what we want to do is encourage people to use robots in a more creative way to create shared prosperity and not just automate existing jobs.
I think this is fascinating, actually. To that point, you've just launched a $1 million prize money for high-tech companies that do indeed increase job potential for middle wage earners, for low wage earners, entrepreneurs that adopt high tech but actually helps those. This is on the same day that actually the World Economic Forum is coming here to San Francisco with a center to focus on the fourth industrial revolution and how we can have practices and best ways of ensuring it's for the public good as well. How can these things be for the public good? What sort of technology are you envisaging here?
Yeah, I'm delighted the World Economic Forum is also stepping up. And here at MIT, we recognize that technology is a tool, and robots are tools, and they can be used in lots of different ways. They can be used to automate work and lower wages. They can also be used to make work more productive and creative and increase wages. The trick is to steer people in the right direction. There are a number of companies that are working very hard on that, and one of the reasons we created that $1 million Inclusive Innovation Challenge that you mentioned is to recognize and reward the companies that are doing that. For instance, there's a textile mill here in Lowell, Massachusetts, nearby, that has put in some machinery that allows their textile manufacturing to be much more flexible and personalized, customized, and as a result, it's more valuable. They can pay their workers much more than they're paid in other countries, and create more value for customers at the same time.
I mean, I just mentioned the fourth industrial revolution there. Your book, which I'm halfway through, The Second Machine Age as well, brilliant read. These show that, you know, this isn't the first industrial revolution or indeed machine age that we've had. But is the pace of disruption that much faster this time round? How quickly does the government need to respond as well?
There's no question it's happening faster now. We all have heard of Moore's Law, the doubling of computer power every 18 to 24 months. You know, we did a little analysis in that book, The Second Machine Age. The steam engine also improved, but the doubling time was about once every 70 years. So it's a whole different scale of improvement and speed now. And it's affecting many more jobs. It's affecting the whole information economy, which is, most of us do information work these days. So it's a real important change that we're seeing. I think that if we handle it right, it's going to be one of the best things that ever happened to us. But it really depends on not just government policies, but also policies by CEOs and decision makers, and by all of us as workers, the kinds of education we get. There are a lot of changes and a lot of dimensions that need to be made.
I mean, certainly this is something that IBM and Salesforce were putting to the government in terms of potentially retraining and ensuring that's happening within businesses. I mean, I have a race on, of course, to finish your second machine age, because you've got another book coming out, again co-authored with the same Andy, and this one is called Machine Platform Crowd, Harnessing the Digital Revolution. Interestingly, in this book, you say you must rethink the integration of minds and machines. Now, another man who thinks about the integration of minds and machines is Elon Musk. Do you view that his view is right, that potentially will come some sort of cyborg and that's the only way that humans really can remain relevant?
Yeah, you know, I've talked about that, and I think he's right in the long run, but that's not really what we're talking about so much in our era, our generation. We're much more focused on having data-driven decision-making and artificial intelligence and other tools that allow human and machine decision makers to work and coordinate and divide up problems in ways that they can be more effective. Someday, eventually, we will have that direct net on our brains that allow us to communicate with machines, but I don't think that's anything we'll be buying in 2017.
Erik Brynjolfsson, Professor of Information Technology, of course, at MIT Sloan School of Management. Good luck with the competition, and thank you very much indeed for joining us today. Now, coming up Friday on Bloomberg Television, noted short seller Carson Block from Muddy Waters will join Bloomberg Daybreak Americas, talk about his latest position in the market. Catch that conversation 8 a.m. Eastern Time, 12 p.m. in London. Coming up, the US Senate just sent a big message to internet service providers. What it means for your data. That's next. And this is Bloomberg. Now to a stock we're watching. Shares of Bitcoin, well, not a stock, of course, it's an asset. Bitcoin had a strong trading day. The cryptocurrency was up almost 3% at more than $1,000 per coin. This after the aggressive selling on Wednesday slammed the currency below the $1,000 level for just the second time since the beginning of February. 2017 has been a volatile year for Bitcoin. It rallied 20% in the first week for the year before crashing 35% amid fears of a crackdown on trading by China. Then rallied again another 75% from mid-January until mid-March, hitting a record high. That was, though, before the SEC's rejection of the Winklevoss ETF. Meanwhile, the US Senate has voted to overturn the Federal Communications Commission's broadband privacy rules. The rules that were finalized in the last months of the Obama administration would have prevented internet providers from sharing your web browsing history without permission. The final vote tally was 50-48. Joining us to discuss from Washington, D.C. is Bloomberg Intelligence litigation and government analyst Matt Schettenhelm. Matt, great to have you with us. And the US Senate took up the FCC privacy governing the internet service providers this afternoon. It voted, it went against it, but remind us exactly what the privacy rules would have done to ISPs.
Sure. So the heart of this issue is how your internet service provider can use data about how you use your smartphone, how you browse the internet. And what the FCC's rules from late last year basically did is they said that before your internet service provider, AT&T, Verizon, Comcast, Charter, before they can use that data, they have to ask your permission at the front end. And why that's so bothered the companies, the cable companies, the ISPs, is because the companies that dominate this online ad revenue market, Facebook, Google, they don't have to do that. They don't have to ask for your permission at the front end. And so the ISPs came along and said, this is burdensome, this is unfair.
Because the FTC has a very different view on things, and it's more of an opt-out. So it seems as though an opt-out could be on the agenda now for the ISPs. But how likely? It's got voted in the Senate and now has to get through the House. Will this become law?
I think it's a very good bet to become law. Most legislation is harder to pass through the U.S. Senate. The Republicans have an even larger edge in the U.S. House of Representatives. They passed this today strictly on a party line basis, with 50 Republicans voting for, 48 Democrats voting against. I think they'll have an easier time in the House, and I don't think there's any doubt that Donald Trump will sign it.
Certainly, that was what many people felt. He was against these sorts of elements, and particularly against perhaps net neutrality. And this is something that Ajit Pai, the new head of the FCC, has also voted against previously. Can we make a leap here from the fact that the privacy laws are being undone, that this could be the same case for the overall net neutrality rules as well?
I think net neutrality is certainly the elephant in the room, and that is the next big fight that's coming. But it's important to note, I think, that it's going to be much harder to undo in Congress. As I said, this passed by the narrowest margin, and it did so with the Republicans using a rarely used measure that didn't require them to duck a filibuster. So they only needed 50 votes. They don't need 60 votes. With net neutrality, it's not going to be that easy, and they might need to do a little more compromising. It might be something that, if Congress can't tackle, Ajit Pai at the FCC might have to take a second look at it himself.
I mean, actually, interestingly, this law also sort of reins in the FCC going forward as well, what the Senate passed through today.
Yeah, I mean, arguably, one of the aspects of using this filibuster skipping law is that it prevents the FCC from adopting substantially similar rules in the future. It's not clear what that means because this provision's never been used before. But I think what is likely is the FCC is likely to step back, and it's likely to look to the FTC and to states to step into the gap on filling in the privacy regulation.
Bloomberg Intelligence analyst Matt Schettenhelm, thank you very much. A complex story that you brought to us perfectly. Thank you very much indeed. Now that does it for this edition of Bloomberg Technology. Remember, all episodes are now live streaming on Twitter. Check us out. It's at Bloomberg Tech TV, weekdays at 5 p.m. in New York, 2 p.m. in San Francisco. That's all for now. This is Bloomberg.